Hey guys, what's up? I'm Erin and welcome back to the channel. We've all heard different safe withdrawal rates. Maybe it's 3%, maybe it's 4%, maybe it's 5%. How do you know which number is right? Well, today we're going to open up the hood. We're going to see how these figures are calculated, and by the end, you'll know which one is right for you. Here's the truth. These aren't competing facts. They're answers to different questions. Change the horizon from 30 to 40 years, tighten the probability of success, switch the inflation rule, or build a different portfolio, and the safe number moves. That's not a bug, that's the math. So today we're going to walk through 3 different legitimate research lenses. Morningstar's forward-looking Monte Carlo, Pfau's yield-aware approach, and Bill Bengen's historical worst-case scenario. Then we're going to build a $1 million portfolio for each, show what each of the draws look like and how they evolve over time and how they change depending on what you're solving for. So in the end, I don't want you to walk away with just a withdrawal target. I want you to understand the number and have the confidence to know whether it is the right approach for you. Method 1, Morningstar's Monte Carlo 3.7%. Here's the idea in plain English. Morningstar is looking forward, not backward. They're running market simulations based on their own allocations of stocks, bonds, and cash. They use a baseline retirement of 30 years, adjusting for inflation on an annual basis and targeting a probability of success of 90%. With a balanced allocation where the sweet spot for equities is 20 to 50% of the portfolio, their latest baseline suggests a safe starting rate of 3.7%. Let's take a quick detour here and talk about a Monte Carlo simulation. This just means stress testing your plan against thousands of plausible futures. You feed in expected returns, volatility, corrections, and inflation. The model then generates year-by-year market paths, applies your withdrawal, and then counts how often this portfolio lasts until year 30. That share is your probability of success. And because it draws from probability distributions, we're not just looking at historical scenes we've seen, we're also playing out futures that we've never seen. So we get exposed to a broader range of possibilities. Now, a year or so ago, this recommendation was around 4%. So why the drop? Well, their future projections on returns softened a little bit. We've seen equity valuations move higher and bond yields drift lower, which has pulled expected returns down and thus the safe withdrawal with it. Now, flexibility matters, and a guardrails plan is just a spending rule with bumpers. Here you start with a targeted retirement paycheck, and if the market performs poorly, you reduce the amount that you take out of your portfolio. But if the market performs well, then you give yourself a raise. And if you're willing to do this, if you're willing to dial back your spending a little bit in poor performing years and increase your spending in the years where it performs better, Morningstar says you can start with a higher rate of withdrawal, that being 5.1%. Morningstar also offers a slightly simpler version. If you don't want to deal with the guardrails and adjusting up if the market performs well and adjusting down if it performs poorly, instead, you can start with a targeted withdrawal, adjust up in the good years by the amount of inflation, and then in a down year, simply skip your inflationary raise. If you're willing to do this one switch during your retirement, then you can start with a higher targeted withdrawal, this time 4.2%. Now, length of retirement matters. When Morningstar originally ran their projections, they were looking at a 30-year retirement. But what if you want a longer retirement? What if you want something in the ballpark of 40 years? Having a longer retirement inherently introduces more risk because you need your money to last for longer. So, with a longer retirement, you need to adjust down your withdrawal. Morningstar suggests going from 3.7% down to 3.1%. Morningstar didn't suggest an exact portfolio. Instead, they tested a range with 20 to 50% in equities and the remainder in fixed income or cash-like equivalents, all trying to produce a probability of success of at least 90%. So to stay true to this framework, here's a demo mix we might use. 50% stocks, 45% bonds, 5% cash. The starting paycheck on a $1 million portfolio using a 3.7% withdrawal would be $37,000 in year one. The inflation raise kicking in the following years. Say we had 3% inflation. Year two, the withdrawal looks like $38,000. Year three, $39,000, and so on. Now remember, if you're willing to be more flexible, adjust your spending based on how the market performs, or if you're willing to pause your inflation raises in market downturns, you can start with a higher withdrawal percentage, but it's up to you and how you would like to schedule these. Method number 2, Wade Pfau's Yield Aware or TIPS ladder, 4.6%. TIPS are Treasury inflation protected securities. Pfau's stance in one line might be insure the basics, then invest the rest. First, you lock in an inflation-protected income floor. This might be Social Security, a pension, and your TIPS ladder. Then you invest the rest to protect your upside and invest for a legacy. So what this method is you essentially pre-buy your retirement paycheck with a 30-year TIPS ladder. Treasury bonds that increase with CPI, or the Consumer Price Index. You hold one bond set to mature each year for the next 30 years, sized to deliver that year's spending in today's dollars. You hold each rung of your TIPS ladder to maturity, and that way you aren't affected by market swings with your cash flows. Here's the catch. The paycheck you lock in moves with real TIPS yields. A higher yield means a larger paycheck for you. A smaller yield means smaller paychecks. Lately, this has come out to be roughly 4.6% real for a 30-year ladder, about $46,000 real from $1 million investment, but it changes as yields change. So think of buying 30 inflation-proof coupons, each for one future year of your retirement. When real yields are about 2% plus, these coupons are relatively cheap. So each $1 you invest can fund about 4.6 cents per year after inflation for 30 years. That's the whole idea. 4.6% is today's market rate for guaranteed inflation-linked income for the next 30 years, but it's not a forever rule. Pfau's approach doesn't really change. Lock in the floor and invest the rest. But what does change is the number you can lock in, because it is based on today's TIPS rates and that fluctuates with the market. Here's how the ladder is built. It's not just a theory. Imagine 30 envelopes, one for each future year you'll need money. Start with the last envelope, year 30. Buy a TIPS that will pay exactly what you need that year. That bond also drips small coupon checks into earlier years. Move to year 29. Buy enough so year 29 is covered, but subtract the coupon money you're already expecting from the year 30 bond. Keep stepping backward, year 28, 27, 26, each time topping up only what's still needed after counting those coupon drips. If there is no bond that extends to the exact year you need it, you would buy the closest year you could, then when it matures, just set that money aside until the year you need it. Now, because these TIPS increase with inflation, each envelope will have the same buying power once you open it. All costs are known upfront. You're just shopping for a bond with today's price tag and putting in an envelope for when you're going to need it. Now, the pro here is that you have near certain funding for the next 30 years. Treasuries that are linked to CPI. You essentially neutralize sequence risk. Now, the downside here is within this bucket, there's not going to be much left after these 30 years. You're spending down the principal. You're also missing out on what you could otherwise capture as a return had this money been invested in the market. Also, the rate you get depends on the rate you lock in. So let's do an example. Let's say you have $1 million portfolio and you can get 4.6% ladder pricing. Paycheck in year 1 would be $46,000. In year 2 and beyond, it would automatically inflate with CPI. Now, this is very important to state. Pfau is not anti-investing. Here's what he wants you to do with the rest. The ladder covers your needs. The market portfolio covers anything else. Maybe you have a retirement that extends beyond 30 years. Maybe you want to leave a legacy. Heck, maybe you just want spending money beyond your needs. This is where this money would live. But this is really a safety-first approach, making sure your needs are covered with essentially no risk. Here's what this might look like. Let's look at your essential budget: taxes, utilities, groceries, baseline healthcare. Maybe this is $60,000 a year. Let's say we have a couple here and that their combined Social Security benefits for the household are $38,000. So it gives us a gap of $22,000. So we build our floor bucket. This is our tips ladder for the gap. We want $22,000 in real dollars for the next 30 years. If we can capture 4.6% ladder pricing, the cost for this is going to be roughly $478,000. Actual costs will depend on the specific tips you can buy, their coupons, and the exact yields that day. The remainder of your portfolio would then be invested, and how you want to invest your portfolio at that point really depends on your risk tolerance. And we can look at 3 main archetypes here. Maybe you're risk averse, and even outside your tips ladder, you want a 60-40 stock bond portfolio. This might be a fit if you're somebody who doesn't want a lot of volatility in their portfolio. You might have less volatility, but you are also sacrificing upside with this approach. Maybe after your tips ladder, you're willing to tilt more equities. So you go 80% stocks, 20% bonds. After all, you already have a floor that is covering all of your essentials. So maybe you're okay with a bit more of a bumpy ride if it means that you can capture higher long-term gains. Or maybe you go 100% stocks with this portion of your portfolio. This is really maximizing your upside, and because you likely don't need strong pulls from your portfolio, remember your tips ladder is covering your essential spendings, maybe you're okay with maximum volatility with this portion of your portfolio. It really depends on your risk tolerance. Now, ideally, if you do have a portfolio that fits one of these, you do want to rebalance on an annual basis, and if you're using draws from your portfolio, use the dividend payouts first. Now, why this philosophy might fit? If you have a very risk-averse nature, this income floor essentially removes all the what-ifs of how the market performs or what if inflation increases. You're essentially covered on all of your essentials, but you still have a portion of your portfolio that is invested and capturing the upside. And method number 3, Bill Bengen's historical worst-case scenarios. 4.7%. The original version of this was the 4% rule, drawing 4% of your portfolio in the first year, then adjusting for inflation in subsequent years, and having a portfolio that lasted for 30 years. Bengen asked, what starting rate would have never failed across every rolling 30-year period since 1926 for a given portfolio? He called the worst-case pass rate SafeMax. Bengen's latest research built a more broadly diversified portfolio, and inevitably now his research shows that SafeMax rate has been increased to 4.7%. Even in casual commentary, he suggested that brand new retirees today might be safe to use a withdrawal of 5.25 or even 5.5%, but he does say that is not a worst case guarantee, that's a situational call. Now, the SafeMax number looks at all historical worst-case passes. So essentially, if you had retired at some of the ugliest times for the market in our nation's history, whether that was the Great Depression, whether that was stagflation, the 60s or 70s, what withdrawal rate would allow you to maximize your portfolio and have a safe withdrawal every single year? This is a pass-fail. This is not a probability of success. It is just strict pass or fail. Did the portfolio succeed? Now, portfolio recipe matters here. He does test a range of different portfolios, and often the portfolio we tend to hear about most is 55% stocks, 40% bonds, and 5% cash. But as those portfolio allocations change, the SafeMax number does as well. So how this works in practice. Number 1, you pick your portfolio, you invest, and you rebalance annually. 2, you withdraw a fixed real amount. You choose your starting withdrawal, and based on research, that would be 4.7% of your portfolio, and each subsequent year you do adjust by CPI. Also, you make sure to rebalance your portfolio on an annual basis after taking your draw. You'll sell the overweight categories to get back to target. More stocks after strong stock years, or more bonds after strong bond years. And as always, it's a good idea to keep a strong cash reserves for whatever life might throw at you. That might be 6 to 12 months in reserves. And number 3, you simply stay the course. The promise of success comes from consistently following these rules across the entire retirement horizon. Our example portfolio here might be 55% in global equities spread across large, mid, and small cap, 40% in high quality bonds, 5% in cash for rebalancing or smoothness. If we have a $1 million portfolio, in year 1, you'd draw $47,000. In year 2, assuming 3% inflation, about $48,000. Year 3, about $50,000. Again, assuming that 3% inflation. The strengths here are that this system is intuitive and battle-tested, so to speak. You can point to any point in history and say, this portfolio has survived even the worst of times, but it does require discipline. But the caution is that it assumes the future rhymes with the past. It is heavily influenced by the US history, and it doesn't factor in today's valuations and today's projections the way future-looking models might. And if you change the portfolio or you skip the rebalancing, the historical promise no longer applies. Bengen's number is the highest start that has never failed in US history for a specific diversified mix and strict rules. It isn't a 90% probability. It is a historical worst-case scenario success. Now let's draw a comparison of these portfolios. We'll assume a same $1 million portfolio for each and assume CPI is 3%. Morningstar, 3.7%. This is forward-looking, Monte Carlo simulation, 30-year plan, about a 90% success target. So in year 1, you're getting $37,000. Year 2, about $38,000. Year 3, about $39,000. The point here is this is not a guarantee. This is a probability target. In 9 portfolios out of 10, it was successful, but there was the one where it failed. So what probability of success are you comfortable with? And if you're willing to introduce guardrails or be a little bit more flexible with your spending, you can start with a rate that is a little bit higher. But know that you get to make that inflation adjustment over time, and you do have a portfolio that should maintain purchasing power. Pfau, 4.6%. 30-year tips ladder where you pre-buy your retirement paycheck. Year 1, $46,000. Year 2, $47,000. Year 3, nearly $49,000. This is guaranteed CPI-linked cash flow from treasuries held to maturity. There is no market sequence risk on the floor, but the trade-off is the payout moves with real yields and you're spending the principal. So there will be little to nothing left after 30 years unless you have another pot of money that is otherwise invested in the market. Finally, William Bengen, about 4.7%. Historical worst case pass with a dividend and rebalanced portfolio. Year 1, $47,000. Year 2, $48,000. Year 3, about $50,000. This is the highest starting withdrawal rate that has never failed across any 30-year rolling period in U.S. history. It is not a 90% probability of success. It is strictly a pass or fail based on historical data, but it does require you sticking to the portfolio and rebalancing on an annual basis. So what's the real difference? Morningstar? We want a high probability the plan lasts for 30 years given today's assumptions. Pfau, we want a guaranteed inflation-linked paycheck we can buy today and to turn market risk off for essentials. And Bengen, we want the highest start that has survived the worst historical start dates if we follow the rules. So which one is right for you? If you want absolute certainty for essentials, go with Pfau. You've got a CPI-linked income floor, and you can simply invest the rest. This completely takes sequence risk off the table, but you will be spending down your principal. If you want a probability target tied to today's markets, go with Morningstar. You can start with 3.7% if you're planning a standard 30-year retirement. You might have to adjust down to 3.1% if you're planning a longer 40-year retirement, or if you're willing to introduce guardrails, you can adjust up to as high as 5.1%. If you want history's toughest test and can stick to rebalancing, go with Bengen. You can start with a 4.7% safe max number. Make sure you have a portfolio that fits the parameters. The one he often talks about is 55% equities, 40% bonds, 5% cash. Remember, this is a historical pass or fail, not necessarily a future predictor. Ultimately, pick the lens that reflects your comfort with risk, your willingness to be flexible, and your time horizon. Now, if we were to take a moment and try to build a model of each of these portfolios, here's what it might look like. With Morningstar, it might be 40% global equity, 55% US core bonds for intermediate needs, and 5% cash. If you built this portfolio, then you could have a starting withdrawal of 3.7%, give yourself CPI raises, and have a 90% probability of success over a 30-year time horizon. And importantly, you'll want to rebalance annually. And remember, if you're willing to adjust your spending based on market performance, you can justify a higher start. For the Pfau style portfolio, we're building a tips ladder with rung maturities each year 1 through 30 to cover all of your essentials. If you wanted to create a blend, you might be 80% ladder and then 20% to equities for upside, legacy, or life beyond 30 years. For a Bengen style portfolio, you might have 55% equities spread across large, mid, and small US and international, 40% high quality bonds, and 5% cash. This would allow you to start safely at 4.7%, give yourself CPI raises, rebalance every single year, no matter what, and ultimately you would fund your withdrawals from any portion of the portfolio that was overweighted that year or use part of your cash buffer. 2 reminders that I do want to add here. If you're planning for a longer time horizon in retirement, rather than 30 years, maybe you're looking at 40 years, you do want to adjust down that withdrawal rate just for safety and to make sure that portfolio lasts. Also, these models don't factor in fees or taxes, so you do want to make sure that that is factored in with your projections. So ultimately, who is right? All 3, based on their assumptions, and your job is to pick which question do you want answered. Do you want a guaranteed floor? That's Pfau. Do you want a high probability plan tied to today's markets? That's Morningstar. Do you want to survive history's toughest with a pass or fail? That's Bengen. Then your job is to lock in your details, your time horizon, your success standard, your flexibility levels, and your costs and your taxes. With retirement planning, consistency beats perfection. When you look at these models, pick the one that aligns with your comfort with risk and try to stick to it and keep going forward. What are your thoughts? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Different legitimate research lenses. Wow, I heard it. Ooh, I saw the little hairs on this mic dance around. I think I was breathing too hard. Expected with which has pulled Apparently I was mad at my microphone. I almost hit it over.